All right, well, joining me on the line today is Meb Faber. He is the co-founder and the chief investment officer at Cambria Investment Management. He's authored numerous white papers in 3 books, Shareholder Yield, the Ivy Portfolio, and Global Value. Meb, it's great to have you on Follow the Money. Thanks for joining me.
Thanks for inviting me. It's great to be here.
Yeah, absolutely. Well, I have been talking about you a little bit to our trading audience recently because you have put out some great white papers that are absolutely free. People can download. In fact, we're going to put some links to them on our website today along with this show. And one of them in particular that really caught my eye was entitled Relative Strength Strategies for Investing, and it puts forth a sector rotation strategy. And I want to talk to you about that in just a minute. But before we do any of that, I am very impressed that your background is not necessarily finance, even though you have a CTA and you have, of course, now you're managing ETFs and all of this. You didn't come in through the finance door. Tell us a little bit about what sparked your interest in finance.
Like many, my father was very involved from me, even a young age, in being interested in the economy as well as investing, which all bleeds into a bunch of other areas, geopolitics, et cetera, and even travel in currencies. And so from a young age, I was very interested in investing. That carried throughout college, where I was studying engineering and biotech. And So I studied engineering in college, and it spent a lot of time still investing. And this was in the bubble years, late 90s, early 2000s. And so it was certainly exciting and a lot of fun. But my original plan was to go back to grad school to get a PhD in biotech, but took a year off to go make some money because life sciences PhD can take a good 5-6 years. And that, those little decisions, the little fork in the road at the time seems like, this year off to go try out the investing world. My career became my hobby and vice versa. And so now I still love biotech, still very curious and follow it, but more as a hobby than a career, and have moved pretty far away to the quant side of the investing world.
Yeah, and tell us a little bit about Cambria Investment Management. You actually manage ETFs there. Tell us about your overall philosophy and objectives there.
Well, so we started out in 2006, started managing money in 2007, SEC registered. We do individual accounts. We have 2 hedge funds. And then, like you mentioned, the bigger push in the last few years has been public ETFs. And basically the premise for everything we do is we want to launch strategy-based funds or concepts that work and have worked historically, but also that have a fundamental reason why they work. When I say fundamental, I don't just mean fundamental in the technical sense of, Warren Buffett style investing, but rather something you could explain to your 15-year-old niece or nephew and them understand it. And so we fully believe in various types and styles of investing. And there's different types that work, such as value, like Warren Buffett, or momentum and trend, like many traders implement. And a lot of it has to do with certain philosophies and how you look at the world and how you emotionally can deal with the challenges of investing. And so it's been the last criteria certainly, is this a strategy that I would want to put my own money into? And I have 100% of my net worth in our ETFs, just to show that, it's something that we believe in and certainly want to eat our own cooking.
Wow. So all your money is in the strategy itself. Wow.
Yeah. Well, we have, probably the vast majority of my net worth is wrapped up in my company, and certainly have a few other hard assets like a family farm in western Kansas and share some real estate with my brothers. But all of my investable net worth, 100% is in our funds.
And that's something. How do you feel about the stock market right now? Are you getting a little skittish? Obviously stocks are coming across very expensive according to many metrics.
So there's good news and there's bad news. If you look back historically to, say, 1900 in various stock markets around the world, I like to use a little rule of thumb, and I call it the 5-2-1 rule. And this is how much stocks, bonds, and bills have returned on a real basis. So this is net of inflation in all the markets around the world back to 1900. So stocks have been around 5%. It's been more in the U.S., but the U.S. has been one of the best performing markets in the world last 120 years. Bonds are around 1.5%, but I rounded up to 2, and then T-bills around 0.5%. I rounded up to 1 just for easy to remember. So 5-2-1. Well, the problem is right now, the bad news is that U.S. stocks historically, if we look at long-term valuation metrics like 10-year PE ratio, many call the Shiller-Cape ratio. Historically, it's around 17. Currently, it's at 28. Now, we actually don't think that's a bubble. It hit a peak of 45 in the late 90s, but it's also hit values as low as 5. And valuation is a very blunt tool, so it's not going to tell you what the market's going to do tomorrow or next month, but rather it gives you a pretty broad guide as to what the market will do over the next 5 to 10 years. And so the U.S. is expensive. There's no question about that. There's other valuation metrics. Anytime you use a valuation metric, they all should say similar to the same thing. So, for example, the average stock, or what we call the median stock in the S&P 500, if you look at price to sales, it's the highest it's ever been all the way back to the 60s. So, but they tend to say the same things. You could use Buffett's favorite, market cap to GDP. You could use price to book, price to cash flow, Tobin's Q. Any of these, they all say the same thing, is that stocks should return low single digits. So that's the bad news. Now, it's not terrible. It's not that they're going to should return negative like in the late 90s. The good news is most of the rest of the world is really cheap, or it is cheap, and then parts of the world are really cheap. So if you look at foreign stocks, which, by the way, include roughly half of the world's market cap, most people, that's a surprise to them. Most people in the U.S. who invest in stocks have about 70% in the U.S. market, and that's a home country bias. It really should be around half at a minimum.
Interesting.
Yeah, and it's the same way. Look, I'm a Denver Broncos fan. Same way, you may be a Razorbacks fan. I don't know, or someone else is a Yankees fan. Is that it's home. It's what's comfortable. It's what feels. But everyone around the world does this. Italians invest most of their assets in Italian stocks. French, Aussies, Brits, they all do the same thing. But it's a really suboptimal thing to do. And so if you look at, at a minimum, John Bogle style indexing, you want to have at least half in foreign, particularly now when the U.S. is one of the more expensive. So the foreign developed and emerging indexes are trading at around 15, U.S. is around 28. And if you look at the cheapest 20% of the world, so looking at 45 odd investable countries, you have a long-term PE ratio in the high single digits. Now the challenge with that, of course, is that you're investing in what is almost always the worst geopolitical headlines. So almost all of Europe, emerging Europe, the pigs, but also countries like Russia and Brazil. But historically, when you invest in the cheaper markets, and we outline this in our book, Global Value, it's a much better place to be than investing in what's expensive.
My guest today is Meb Faber. He is the co-founder and the chief investment officer at Cambria Investment Management. Meb, what about China? China has been in the headlines quite a bit lately, and I know that I have been enjoying the rise in the A shares now for several months. What are your thoughts on China? Is it being overdone in the media, or are they overplaying it in the media, or should we really be fearful?
The media overdoes everything, right? Look back to 2006, 2007, China and India were trading at valuations for the long-term PE up in 40, 50, 60 range. So truly bubble territory. Remember, U.S. only hit a peak of 45 in 99. So China and India were up in the 40 to 60 range. And the reason they've had such horrible returns through, say, maybe 2013 or so was that it took 5, 6, 7 years to work off of that valuation headwind. And then everyone loved China and the BRICS in 2006, 2007, right? And then now, fast forward the number of years, no one wanted China or India in 2012, 2013, 2014. India was one of the best performing markets in the world. Was it last year or 2 years ago? Last year, I think. And yeah. China has had an amazing run now. China hit a valuation on that long-term PE ratio of 12. Whereas, remember, at the peak, they were up in the 40 to 60 range. So when it finally got cheap, no one wanted it. And then it started to go up, and it's had an amazing run. So that's kind of the wash, rinse, repeat cycle in the media. When everyone wants something, there's a famous Templeton quote where he says, "Don't ask me where things are the best in the world. That's where things look rosiest. That's the wrong question. Ask me where things are most miserable." So where the places you probably want to be investing in equities right now for valuation are the places where you probably don't want to be. That makes you nauseous to think about. If Russia is a great example, while it was one of the worst performing stock markets in the world last year, it got down to a valuation ratio of around 4 or 5 at the end of 2014. And it's now, I think, the best performing stock market in the world this year. So you can, once things get really cheap, there's a lot of opportunity. And so China is a perfect example. When no one wanted it, when it finally got down to a cheap valuation, that's when things started to turn around.
Yeah, low prices, the cure for low prices, it seems. And yeah, Russia has been on fire this year, as well as a few other markets. India, I think last year was the biggest winner. And I guess there's all kinds of different reasons behind all of that. We won't get into that now. Certainly, I want to kind of shift gears and talk to you about the concept of trend following before we talk about sector rotation. I'm a big trend follower. I have found that it has worked for me, and I know that many people out there kind of boo the whole idea of trend following. It doesn't work. You have a CTA certification. You are explain what that is to the folks, because many people may not know what that is. They've heard of the CFA, but what's a CTA?
CTA is Commodity Trading Advisor. They've been around for over 30 years, and it simply means they are typically have been trend followers. But in early days, it started out trading futures, but nowadays it's come to mean a lot of different things. And so a lot of our portfolios and strategies are based on trend and momentum work, which we just shifted from value to trend, which for many people, it's like being an atheist and a Christian, or a Democrat and Republican. Very rarely do the two sides philosophically can agree. And the funny thing is that my favorite setup in the entire world is the intersection of value and trend when something is cheap is also going up. And that's where you get the really, in my opinion, the best returns. And it happens in markets all around the world. It hasn't been the case in 2014. Most of the expensive stuff, U.S. dollar-based assets, were what was going up. So U.S. stocks, U.S. bonds, REITs, and most of the cheap stuff was going down. That looks to be changing in 2015. We'll see. But it's a